Zebra option trading strategy is the best thing since sliced bread, and in this video I'm gonna show you how to make $400 for every $1 move in DraftKNG stock, with stocks to pick and focus on when you wanna trade Zebra, and why I think this is so much better than Leap's option strategy. Let's get started. My name is Ziv. I like to sell naked puts on Tasty Trade, but sometimes I diversify with Zebra, with Jade Lizard. Subscribe. Let's get to it. So I have a watch list. This is my watch list. All those stocks, forever put, month 1, month 2, month 3. I sell naked puts on those stocks. There's like 50 or 60 stocks. Every day check my channel. This is not the focus of this video. I got Iron Condor, which I use less, Magnificent 7, and Leaps or Zebra, which is this category. What is a Zebra? Let's start with this. A lot of you like Leaps and all that. What is a Zebra? Zebra means two things, very simple. You buy, okay? I'll make it simple to you. You buy two in the money calls, okay? That have a delta around 70, okay? So 70 plus 70, we are dealing with deltas in here. You're buying, again, two delta 70 calls in the money, okay? So DraftKNG right here is 43. I'm gonna show you the exact trade. I have put, let me change this to 1 to 2 and 1. I'm gonna show you exactly. You're buying two of the, let's go back. Let's go back to analysis tab. Right here, you buy two of the 30 delta, okay? I'm just doing DraftKNG as an example. I'm gonna go over all the stuff. You see the delta here, 82. 82 plus 82, 164. Simultaneously, you sell one call. You sell one call, that's it, which is like 50 delta to get to about 100 delta, 90, 95, which is like Leaps but better. So let me show you what I mean. DraftKNG 43.55. I'm just doing an example. I'm showing you. You buy two of the 70 delta, and I'll show you why I picked this one, and you sell simultaneously. Let's do the math. 270 delta is 140, and then you sell one put, one call, 50 delta. So 140 is, we got two delta, 270 delta is 140, and then you sell simultaneously a little higher call strike of 50. So 140 minus 50 delta, you aim for about 90 delta. I like to get close to 100 because I like to be a little more conservative, but the upside potential is absolutely massive, and it's much better than Leaps, and I'm going to show you why, plus the stocks that I have on the list. So what have I done? I put an example. This is not 8 ATR, this is not all of that. This is just a stock replacement. That's what they call it on Tasty. I like to call it Leaps on steroids, much better than Leaps. I don't know. That's the Zebra strategy. I have picked two 30 calls, and look at the date. I have picked December 19, 2025. The market is closed. I'm doing this as an example. I haven't taken the trade. I'm just trying to explain what is a Zebra. 393 days. You can pick whatever that you want. When I do Zebras, I go over a year just because of the tax implications, and I let the trade ride all the way to a year from now and see where it goes. It hasn't expired yet, the trades that I've taken. 393 days to expiration. It's over a year. I picked this one for the example. I picked the two 30 calls. Okay, you see the delta here, 82. That's 164. And then 164, I sell, in comparison, I sell one call, 66. So 164 minus 66 gives me 97 delta. You see here, here's the trade. Two calls for next year, 230 calls, and 140 call that I sell. Let's analyze the trade, and then I'll show you why it's much better than just plain old simple classic Leaps. This trade costs $2,400 in buying power. That's it. 44% probability of profit. The aim of the zebra is to get to 50%, but I assume my goal is to be bullish on DraftKings, okay, for this specific example. Delta, this is the key, 97 delta, 97.33. What does it mean? It means that if DraftKings goes up, if you take this trade today and tomorrow DraftKings goes up by $1, 43.55 goes to 44.55, you made $100. This option will be worth another $100 in the profit. That's it. This is your debit, okay? You're paying $2,400. This is your max loss. Keep in mind, this is your max loss, $2,400. Every dollar the DraftKings goes up, you make $97, okay? Now here's the alternative. Here's the alternative that you gotta understand. This is the zebra. Let's go over this again. Zebra, you buy two 70 delta calls and simultaneously you sell one 50 delta calls to get to around 90, between 90 to 100 delta. That's your goal. I like to be over 95 delta just because I like to be already in the money on both of them. Tasty says 70-50, which is different. If you do the 70-50 is like 37 here, 72 delta, and the 50 is right here, 49 delta. It's probably cheaper, but then I would wait. My break even will be once I break 50. I don't want to do it. I want to start making money today. So this is the zebra, okay? You buy 270 delta. That's the classic. I did a little, combination of that. The classic zebra, you buy 270 delta, you sell 150 delta calls and calls. This is a bullish strategy for this specific one. You can do the other side on puts. I don't go there. I just focus on the calls. Why is it better than lips? And then we'll go over this trade, and then we'll go over which stocks to focus on. Okay, so let me do this. If you just do lips, okay, if you just do lips, let's remove this. Remember, we are paying $2,400 for this zebra. Okay, if I remove this, okay, and I do one quantity of one, me 1,750, and if I just do two, okay, just like we did before, we did the same thing. If you just buy lips, DraftKings 30 call option lips, the buying power is 3,400. That's the downside. You are paying with the zebras. I've noticed this on the stocks that I've picked, and I assume it's in most cases it's about 30% discount in buying power to just plain on classic lips. I'm not saying lips are bad. I'm not saying that at all. I'm just saying that if you do two 30 calls, okay, two 30 calls lips right here, same date, same everything, you're paying your buying power 3,400. For some, it's not a big deal. It's really not a big deal. If you have a little less capital, if you want to focus on, preserving your capital and all that stuff, you do one sell of this, change this to one, okay? Nope, not both of them, just this. There we go. No, buy two. Do this slide with you. So, and right here, and one of this. So now your buying power reduced by $1,000 from 3,400 to 2,400, about 33% discount in buying power. That's it. That's the big difference between pure lips and doing the zebra. That's what I found out. Here the delta is 97, okay, for this specific trade. Same thing. And if I remove this and just doing the lips, the delta jumps to 160, but the buying power is 3,500. So it's up to you. It's up to you. Now let's say, okay, and then I want to analyze the trade and show you why I like this better than lips. Let's put this back on. But now we do this, change this to one, There we go. There we go. I want to show you, let's change the quantity. Let's say you say, I want to buy $10,000 worth of DraftKings. Okay, let's change this. Let's change this to 4. Okay, it automatically jumped both of them. My buying power $10,000, 9,700, and I'm doing, let's say, for example, in 8, I'm buying 8 calls. Okay, the 30 calls, and I'm selling 4 of the 40 calls. My max loss, okay, is the same thing. My max loss $10,000 in a year from now, only if DraftKings goes below 30 bucks. Okay, same as Lips. If DraftKings goes below 30 bucks by expiration next year, you will basically lose $10,000. So if you wanna make a bet on DraftKings, $10,000, you can option 1. Let's do this. I'm gonna show you why it's much better than just buying the stock. You take this amount, 10,000 divided by 43.55, which is the stock price, you can get 230 shares. That's it. But right now, this 8 minus 4, you control 400 shares. Okay, 8 minus 4 is 4 times 100. 400 shares minus 229, you got extra 171 shares. If you just buy the stocks for $10,000, and if it goes below 30, you still own the shares, 229 shares below 30. That's the risk. But for this risk, we're paying a lot less in capital. Okay, for this specific trade, the delta is insane. $389, meaning that every dollar right now, every dollar that DraftKings goes up, you make 400 bucks. Amazing. If it goes to 50 in a year, $7 from here, you got 7 times 400, that's 2,800 bucks on a $10,000 investment. If it goes below 30, which is now 43, that's like 35% drop. Can it happen? Sure. But if it doesn't, if you just have Lips, you lose again. You will lose the same thing. Okay, so the goal is this: to pick, when you do the zebra, that's my list. You see here, Celsius, Hims, cocoa. That's the coconut water that I drink with a smoothie in the morning. Peloton was $5 like a month ago. Now it's 9. Match, which is Tinder, DraftKings, Roblox, Robinhood was 25, now it's 35. If you notice a theme, the zebra on my watch list, you see it's even called Lips or Zebra. The theme here is to do it on stocks that have like super hype growth in the next year or two. Okay, not stocks. I mean, I'm not gonna do zebras on McDonald's or Coca-Cola or stuff that doesn't move, like stuff like that. That's not, if I'm gonna do the zebras or the Lips, doesn't matter, just the zebras has like 30% less buying power requirements. I'm just gonna focus on growth stocks that can explain, and you can pick your own. I mean, you can do Nvidia if you want, and do Apple, it's up to you. I like to sell naked puts on those. This is my list. I like stocks that have low price. You see the price, 35 bucks, 50, 43, 31, 9 bucks, 36, 24, 20. Not one stock over 50 bucks. Why? Psychology of people. Psychology of people. DraftKings at 43. It was like, I think it was 60, 70 bucks like 2-3 years ago. If it goes to 100, great. Let me show you so that's my point. So that's the watch list. You can copy it. You don't have to. You can make your own list. But just giving you a framework when is a good idea to which stocks to target for the zebra. Another thing to keep in mind, when the trade, specifically when to actually take a trade. When you see this, the IVX 5-day change, this is a filter that I've added from the Tasty Filters. When it's red, when it's the red, it means, let's go over the chart. It means that right here you see the IVR 15. That's good. That's good for me because now I'm an option buyer. Usually, if you check my channel, all my trades as an option seller are when the IVR right here is above 50. If it's above, the IVR is over 50, options are expensive. Simultaneously, if the IVR is below 50, options are cheap. If the options are cheap, it's better to be an option buyer. Okay, so now 15 is super cheap. I wouldn't do this at 100 like 2 weeks ago. So at 15, you get cheaper options, assuming you are bullish on the stock and you believe that the stock will actually go up in the next year. What do we got? And then I'll show you the difference with the, you know what, let's do this now, and then I'll show you the curve ball. Remember, every dollar up in DraftKings in the next year, every move up for this $10,000, for example, investment, you say, I'm bullish on DraftKings, I'm putting 10,000 on it, let's see what happens in a year, okay? For every dollar that it moves up, you are making $390 in delta, assuming you don't close the trade. Almost $400 for every $1 move in the stock. Now, if I move this, remember we got $9,700 in buying power. This is the zebra, that's the zebra setup. If I remove this to do leaps, if I remove the sell side and I'm staying with 8 calls, 830 calls, the buying power is $14,000. Okay, so this is what you gotta understand, the big difference between the two. It just up to you if it matters to you or not. $14,000 power, buying power compared to 10,000. This is your choice. If you say I'm only gonna do 10,000, then you can't do 8. You can do 6. Okay, so if you do 6, now you're at the zebra level. If you do 8, just like the zebra, you need to put 13,600 on the line. However, the plus side for leaps is the delta. Instead of $400, now it's $655. So for every $1 that DraftKings goes up in the next year, this 8 leaps will make you $655. Something to consider. I just like to do zebras because it's less buying power. If you know me, I like to use as much less buying power as possible to maximize my capital and take more and more trades. So I'm gonna go back to here, okay, and I'm gonna sell this, and I'm gonna change this to 4. There we go. Let's do this zebra again. This is the classic zebra, but now for this $10,000 trade idea, I want to show you the table, okay, the profit table, which is very important. So you go here, you click on curve, and this is the curve ball. Look at this. Let's start with the worst case scenario. If we're going worst case scenario below 30 by expiration, yeah, you see here, you are losing $10,000. Whatever that you put, 9,700, it's max loss. If DraftKings goes to 20, your max loss 9,716. If it goes to 0, $10, your max loss is 9,760. Nothing changed. If it goes to 0, by expiration, you lost 9,716. Okay, so that's the max that you can lose. With worst case scenario, you gamble, then you say, I'm putting 10,000 on DraftKings, and I'm betting it will not go below $30 by next year. That's it. But I'm bullish. If you are bullish and if you are taking this trade, you are doing this, and your break even, look at this. We put $10,000. Your break even is right here around 45. Okay, you see here 45 is where we turn from red to green, and now you start making $100, $400. That's what I said. Every dollar move, you start making $400. Now let's say we moved a little bit, we're price of 50. Okay, you're up to 2,500. Okay, if we go up, if DraftKings goes next year to like $60, which is not out of the blue, you're up $6,500. If it goes up to not the max, but the max for this P&L, let's say $70, like 80% from here, you double your money. $10,000 profit. Now, let's say DraftKings goes to $70, but you only have 229 shares, then you make less. Okay, that's the big difference. If you just bought the stock Okay, you bought 229 shares. Remember that you just bought 100 shares. It goes to 70. You make $16,000. Okay, 16,000 minus minus the 10,000 that you put, you make 6,000. But if it goes to 70 with this zebra, that 10,000 that you put, you double that to extra 10,000. Okay, so that's something to consider. Can you get rich from that? If it goes to like 200 or something, sure, you can always roll it the next year, etc., etc. But it's something to, they call it a stock replacement. I call it buying growth stocks on the cheap, just to be more efficient with my money. People have done it with the hymns. People have done it with Peloton at $5. There's Roblox, there's Robinhood. A lot of those already moved a lot in the last 30 days, but that's something to consider. And you can make your own list of stocks that you feel has growth potential and have a low price of a stock as a buying price. And also try not to forget that when you actually take a trade, make sure that the IV X 5-day change is negative, is red. The IVR is under 50, means buying calls is the better way than selling calls as of now. Hope this was valuable. Subscribe. I'll see you next time.